ask someone about the big key top of mind topics now. We have Alexander Redman, who's the chief equity strategist at CLSA, joining us on the program. Alexander is someone who's made big country weight change calls. The last big call, of course, was moving some of the allocations to China. And in a note which he's put out in the last 72 hours, he's reversed that. He's essentially saying that they've cut their overweight in China, and they're increasing their overweight in India back to its 20% level. Alexander, good to have you with us here from the sidelines of the conference. Prashant this side. The question will be, why are you sort of doing that now? But the bigger question for our audience, right, is this big phase of FII selling that we've seen, foreign selling that we've seen in India, are we at the fag end of it? So why don't you answer that question in the context of FII selling?
Right. Okay. Thank you very much for having me today. So look, the paradox here is that you've seen about $14 billion worth of foreign investor selling since the end of September. I think initially the motivation for that was to participate in the rally that you've seen in China. That initiated with the PBOC stimulus, which kicked off towards the end of September, and caught a lot of foreign investors unawares. I mean, they were sitting on relatively underexposed positions on China, and so used large liquid names in markets like India and Korea to liquidate positions and participate in the China rally. So what we've had now is about 14 billion net foreign selling since the end of September. But the paradox here, of course, is that in meetings that I've had with investors over the course of this year, this is precisely the opportunity that foreign investors have been looking for to actually build up their exposure to Indian equities, where there's been a relatively high degree of frustration that the market has continued to outperform through much of this year, and they've been nursing large underweight positions. So I see ultimately the 12% sell-off as probably sufficient to begin to encourage foreign investors to start to participate in Indian equities again.
All right. Hi, Alexander, and good to see you in. This is Nigel on this side. And that'll be music to the ears of a lot of investors here in India, because our domestic flows have been rock solid. The problem is this big FII selling. So put everything that you've said together, and given that Chinese stimulus, so to call it, has been underwhelming, do you think that bulk of that FII selling is done, and now maybe we could see a bit of a pause, and maybe those flows turn into buy flows as well, since this is the opportunity that they're waiting for?
Yeah, so I reversed the tactical position that I built up in China right at the end of September, essentially for three reasons. One, because the re-election of Donald Trump obviously complicates the China trade outlook. I think we're all familiar with the potential high level of tariff implementation there. Secondly, because I found the NPC stimulus at the end of the previous week somewhat underwhelming. Myself and many foreign investors were looking for the stimulus to be more targeted at consumption, at further absorption of excess inventories in housing, and also to recapitalize banks. And the third point is that with higher bond yields globally now, I think the PBOC will struggle to cut rates further. So having been underwhelmed over the last few weeks or so with Chinese performance, I've decided to reverse that tactical allocation that I made towards China, put that money back towards India. And as I mentioned earlier, I think this is precisely the opportunity that foreign investors have been looking for to get back into this key growth market.
All right, so let's put some numbers to that thesis. You know, from the time when you first decreased your allocation towards India and increased it towards China versus now this reversal, how has the differentiation between both of them panned out? Because what I see is, the up move that we've seen in Hang Seng versus the down move that we've seen in the Nifty, it's a 30% sort of delta that has taken place. That's point number one. And secondly, what are your risks to the current thesis? Because you do say that India has a moat against President-elect Trump's proposed economic and trade policies, where the fear is that maybe something comes by on electric vehicles, something comes by on the IT industry, something comes by on the pharmaceutical industry.
Right.
And the second part is urbanization. You know, that as a theme for India, that also in the last couple of quarters has been under concern, largely because of the urban slowdown itself that we're seeing in India. So in light of all of this, what are the risks to your thesis?
Yeah, I think if you are ordering emerging markets according to their sensitivity to an adverse trade policy from the United States, you need to look at a few things. I mean, one obviously is the level of tariffs, which have been suggested during the campaign. Our understanding is around 60% on China, although we don't know when that would be implemented, and around 10% on other markets. Another thing to be aware of is just the trade exposure to the US. So we're looking at things like overall proportion of GDP, which is direct gross exports to the US, the proportion of overall revenue within markets, which are foreign sales. Other things to be aware of is that with higher global bond yields, clearly you don't want a large degree of leverage. So we've looked at data across net debt to EBITDA across markets. And the other thing, as you point towards, is the foreign ownership level of India. At 17.5%, that is amongst, if not the lowest, across emerging markets. There are some other markets like Brazil, which are upwards of around 60%. So if you combine those five attributes together, ultimately what you want to be is, having a low figure for each one of those. And India, on all of those measures, actually comes out as amongst the least sensitive to a negative trade environment. China, much towards the top. But the other key risk, I think India is well positioned here in an escalation of the trade war. But the other key risk that I would say is more idiosyncratic for India is just the uptick in issuance that you've seen year to date. Now, if you express this as a percentage of market cap, what you've had in the last 4 cycles is when total primary and secondary issuance has hit about 1.5% of market cap, that's when the secondary market has begun to roll over. So that's the kind of the tipping point where Indian equities typically get saturated with primary flow. The key risk at the moment is that we are approaching that same tipping point. And so I would expect the momentum of Indian equities in absolute year-on-year terms to begin to slow down in sympathy with that. But ultimately, this is a relative call, and I still think India is capable of outperforming China at this point.
Okay, that's an interesting point. You're saying cumulative 12-month equity issuance in India has hit 1.5% of market capitalization, and historically that has been a bit of a tipping point, right? I mean, equity issuance, supply swamps the market.
Yeah, so if you look at the if you look at the absolute numbers, they're obviously sky high. We've hit about $66 billion worth now of cumulative issuance in the last 12 months. But you do have to control for the fact that Indian market cap has gone up so much over the previous decades. And when you control for that market cap, you find that 1.5% has been the tipping point in the last 4 cycles, and we're revisiting that level now.
I have a couple of questions here, Alexander. Going back to this sort of India versus China argument, some estimates suggest, and this is again global houses, that about 95% of money which went into China is already left China, and this is it's gone out. It was whatever hot money, whatever, but it's gone out. But that has not meant that that money's come back to India. Otherwise, markets here would have looked very different. Clearly, right? First, would you agree with that? I mean, do you have any way to measure that?
Yeah,
have you looked at the figures?
My understanding is that number may be a little bit overdone. In conversations that I've been having with large foreign institutional investors that participated in the China rally and built up exposure, they typically went from a relatively aggressive underweight stance to around benchmark. Very few have gone to an overweight position on China. Subsequent to that, they've basically held that position, maybe eroded marginally, but I certainly wouldn't think that they have fully rotated that allocation back out of China yet.
Okay. Now, is there one more source of competition for flows, and that is the US, Alexander? Because, I mean, you've got in the US, you've got a situation where it's an interplay between an economy which is seemingly picking up pace and a central bank which is willing to cut rates, right? And we can debate about the pace, but I mean, very much on the cutting path. I mean, that's it's a golden combination. So just your sense,
yes,
what that will mean.
This is an issue that will affect all emerging markets to a greater or lesser extent. If you look historically, there is a very striking relationship between net foreign purchases of EM equities and our year-on-year performance momentum. So ultimately, the fortunes of EM equities are very much dictated by the appetite of large global crossover funds. If that money is then repatriated back towards the United States, we will feel that across all emerging markets, but some will feel it more than others. And this is where I return to the point of foreign ownership. For India, it almost acts like a moat. Having that 17.5% very low ratio of foreign ownership. And of course, what we've seen recently is the SIPs inflows here in India are breaking all-time records. The last month just went above $3 billion net inflows. That more than compensates for the FII exodus at the moment. But U.S. assets, in your opinion, through 25, maybe beyond, will be a big source of competition for foreign money, for global equity money. You would agree with that? Or you think, U.S. equities themselves are too stretched? U.S. is about 66% global equity market cap. Can it go a lot higher? Many would say probably no. Just wanted your thoughts there. Yeah, there are multiple indicators that we look at to call the relative fortunes of emerging versus developed markets. And unfortunately, in the last few weeks, they've begun to change for the worst. One I think that viewers are probably quite familiar with is the inverse relationship to the dollar. In fact, even in the run-up, the dollar was relatively well correlated to the betting odds of Donald Trump, and after his election victory, you've seen the dollar continue to strengthen. That is a significant headwind for emerging markets. The other thing that we have to bear in mind is that in his previous administration, he took the U.S. corporate tax rate down from 35 to 21. That gave U.S. earnings a significant boost, and the differential in earnings growth then favored the U.S. over EM. There may be a case here for history repeating itself, because Donald Trump in his campaign mentioned taking the U.S. corporate tax rate further down from 21 to 15. That incremental boost to U.S. earnings would obviously not be matched in emerging. So it's a second point, again, that would be working against our favor. So you've got that, you've got the flows, you've got the strengthening dollar, you've also got some EM indicators like new orders to inventories, earnings revisions beginning to weaken. So yes, unfortunately, I think it's going to be a far more challenging environment for emerging markets under a Trump administration than would have been under Harris.
All right, Alexander, since we're talking about earnings, the earnings here in India have been disappointing in the past quarter at least, and that's led to a pullback in the earnings estimates by roughly around 8 to around 10%, which coincides with the market correction. So earnings estimates have been cut, and the markets as well have seen a correction. But do you think there's a case for the multiple that we were getting see a bit of a cut, which could mean another down leg for our Indian markets? Earnings estimates have been cut. Do you think the multiple will get cut as well?
I think it's fair to say that we're in a bit of an air pocket now for Indian earnings. Although the forecasts at the moment are still relatively robust. For 25 and 26 calendar year, you're looking at around sort of mid-teens earnings. The consensus revisions at the moment are relatively flat. And of course, the one attractive part of analysing Indian earnings, at least for me, is the very strong relationship with GDP. This is one of the very few emerging markets where that relationship holds true. In most economies, there's a particularly strong mismatch between GDP and earnings in terms of how the sector representation works. For India, there's a pretty good fit. And so we've worked out that there's a very tight fit if you go back over about the last 20 years on quarterly earnings versus quarterly nominal GDP deviation from trend. The R squared is about 60%. And given our current economic projections for India, we're actually quite comfortable with the outlook for earnings. So I see this air pocket for earnings as being relatively temporary. And trying to time that might, frankly, be hostage to fortune. To your second point on valuations, you've already seen some of the overall aggregate numbers begin to soften to a somewhat more palatable level. I mean, if I was to characterize the reluctance year to date of foreign investors to engage in India, it's literally three things: valuation, valuation, valuation. That's it. And so those numbers beginning to come down a bit makes the whole story a bit more palatable. You've seen the price book multiple come down from about 4 times to 3.5. You've seen the cyclically adjusted multiple come down from 38 to 33. These are still high numbers, but India has always been expensive. But it makes it just a little bit more acceptable to start to accumulate at these levels.
Right. You know, you're making a case for India, but at the same time, you're making a relative case for India while talking about things getting a little murkier for the emerging market space on the whole. So if you could, before we let you go, give us an absolute projection that you have in terms of return expectations from the US, from EMs, and in EMs, India and China.
Yes, I mean, I've looked at the way that I come up with an absolute return forecast for India is I map the market. If I use MSCI India, so I can do likewise comparisons across emerging markets in dollar terms. I map it against underlying explanatory variables. So I look at things like US ISM, Indian money supply growth, Indian industrial production growth, and the rupee dollar rate to project forward my absolute return forecast for India. And actually, going into next year on our current projections at the moment, we're looking at sort of low double digits upside for India in dollar terms. But that's the critical thing here is dollar terms. India has recently become a poster child of FX stability within emerging markets. And after the re-election of Donald Trump, you've seen the rupee hold firm significantly better than EM peers. So therefore, on a dollar-for-dollar basis, I do believe that that's a significant advantage for this market versus others.
Right, Alexander, we'll leave it there. A great conversation this afternoon. Appreciate you joining us, and we'll touch base in 2025 again. We must, as we map out what happens for market, in terms of tariffs, trade, and of course markets there. And